Hi Matt, I'm Michael Quinert, Executive Chairman of Wits Mining Limited, ASX listed company with a 75 million market cap, moving into production with our flagship project in South Africa, the Qala Shallows gold project.
Michael, good to see you. Right, obviously good news of the day. DFS is out, and the numbers look better than they were. So is this entirely down to the gold price, or have you been able to make some efficiencies and savings yourself?
The two main drivers, Matt, I mean, obviously the gold price. The last DFS update done 2 years ago was using a base case of $1,850 an ounce. We've now used a base case based on the long-term Bloomberg consensus of 2,850. So it's still under the spot price, but that's compatible with what you do in these sort of studies. So that's a main driver. The other driver, which is connected to that, I suppose, is the fact that we've been able to lower the cutoff grade. There's a lot of ore being left behind under the old 2 gram cutoff grade. It's been dropped to about 1.31. So we're picking up a lot more ore as we develop the project earlier on. And that's led to a few things. Obviously, it's improved the economics enormously, but it's also accelerated the project. And more importantly, I suppose, led to a extension of our steady state production at 70,000 ounces from 9 years to 12 years. So it makes the project on a number of levels look a lot better. Had a big impact on the NPV in that as well.
Okay, well, let's go through some of those headline numbers, as you say.
Yeah, so we've got NPV post-tax now is 500 million US, up from about 264. The net, positive cash flow through the life of the project, almost approaching $1 billion US. Total cash flow is 2.7 billion, up $1 billion. So there's pretty big numbers and big jumps. 88%, internal rate of return. I'm just getting used to all the new numbers because we only released them yesterday. Our all-in sustaining cost has gone up a bit as expected. We've gone from an all-in sustaining cost of just under $1,000 to about $1,288, but that's modest compared to the increase in the gold price, obviously. So most of that was driven not so much by actual cost increases, more the deal we have with the toll treating company, Sabanya, that says if the higher the gold price is, the more they take a share of profit, basically. So we've lost a little bit on that as well. So, but I think in 2 years to have the all-in sustaining cost over the life of the project go from something like at 987 to 1288 or thereabouts is pretty good.
Yeah, okay. And who were the consultants on this? And sort of what work were you doing? What did you brief them to do?
Well, Barra Consulting, the same consultants, Jim Pooley, a good Welshman who'll be barracking for the Lions at the moment, was our main guy. And Jim's been with us for a long time in terms of being the guy doing this sort of work. So he and his team have pretty much spent 6 weeks updating the numbers to account for the new gold price and changes to the mine plan, which was due. I mean, our DFS was 2 years old. We knew it would improve significantly. I didn't think we expected it to improve this much, but the work still has to be done. The mine plan has to change. And also we're updating it because the banks, we've secured first tier bank funding for this project, and the banks will require an updated DFS as well. So that's what we've done.
Right. Well, let's get into this, obviously, because I think maybe some confusion or maybe misunderstanding around how this thing gets financing. So can we talk about the kind of funding structure and debt terms and any other kind of capital constraints? So with a market cap, as you say, around sort of 75, how do you go about it?
Well, the equity route was hard because of the size of the market cap, and that's probably a function more of the trading patterns in Australian small caps at the moment. But I think once we break through into producer, that will change. It's been a challenge. That's why we focused on the bank debt as being a key cornerstone to our funding. So it took us a long time, but in February we announced that we'd reached binding terms with ABSA Bank in South Africa and the IDC, a government-owned institution in South Africa, to provide 50 million US in bank funding to the project. That's subsequently in May, I think that was May, June, we signed the definitive legal documents on that. So it's gone past all the sort of high-level stuff to being a definitive document. The other sort of main source of funds outside our equity contribution is going to be, or is, the production of ore during the construction phase. I mean, this is an underground mine. It's a new ore body, even though it's in an old area. So we do have a construction phase of about 2.3 years. In the second and third year, we produce about 40 to 45,000 ounces of gold, probably more now under the new mine plan. And that ore is all producing, it's development ore. It's lower grade because it's been diluted, but it's all contributing revenue to reduce the external funding requirement for the project. So as the gold price has been going up, our reliance on bank debt and equity has been going down. And in fact, we think at the next round with the banks, when we go back and revisit it now with the new DFS, the bank facility will probably reduce, in terms of its need. We won't need 50 million.
What is it now? Because obviously the debt's, quite frankly, people may not understand, one of the harder things to actually get across the line, because they're a little bit more conservative. They'll want liens against X, Y, and Z. So what are the conditions precedent on it?
They're pretty straightforward, they're the usual security type requirements. They're local South African institutions, so no issues around exchange control approval or that sort of issue in and out of the country because they're local institutions. There's some conditions around our adherence to our BEE compliance arrangements, which we're happy with, but otherwise they're all fairly vanilla. It's a JIBAR rate with a margin. There's nothing, nothing unusual.
And if you've got a kind of, obviously you'll require a grace period or a holiday period on this, but what are the assumptions that they're making in terms of revenue and your ability to repay?
Yeah, I mean, there is a holiday period while we're in construction for a large part of that, but their numbers, remember as well, will be redone because the bank were using a consensus price when they came up with we have a DFS model, the banks come in and do their banking model, and the banking model has more conservative assumptions, as you know. The banking model, the current banking model they're operating on was done at 2,230 gold price, so it's obviously out of date. The consensus price they were using was the same Bloomberg consensus price we've used in the new DFS. So presumably what they'll do is now realign their model to that price. Well, we're asking them to do that, and then we'll come up with a new set of parameters. But, by and large, there's plenty of there's more fat, I suppose, in the project now than there was in terms of their level of comfort and position.
Right, and are they requiring you to hedge some part of this?
Not really. I mean, the hedging, they are, but the hedging is pretty limited. What we're doing is they've required us to hedge about half the production during that construction and repayment phase, and we can do that through put options. So we're not entering a full hedge. So therefore, I suppose a concern for many investors, they've seen it happen in the past. If the gold price continues to go up, we don't have to sell into that hedge. We just won't exercise the put options. So we've had those put options already priced, and they're pretty modest given the spreads at the moment on where the gold price has gone, and our construction costs were done at a lot lower level. So we're sort of we're in a position to put that hedge, that sort of partial hedge, in place very quickly when we get the final funding sorted out.
Right, and sorry to stick with the money at the moment, but obviously given the size of the company, I just want to be sort of clear about the setup here. So in terms of the debt terms, have you allowed a contingency buffer if the project slips, or indeed if kind of gold price does kind of come off, taking the other side of that?
Yeah, they have a requirement for a 15% cost overrun facility. The commercial bank involved was happy with about 7.5, but the government bank, so there's a cost overrun facility, and there's also the usual contingencies built into their model. So there's plenty of scope there.
Okay, now let's look at the financial stack in terms of the kind of phasing of the capital, because you talk in the press release about kind of peak requirement, $44 million. So talk about how the money kind of flows in.
Well, equity is the first money in. So when we finalise that arrangement, that will be the first money in. We're looking at the moment of whether we do a full sort of equity raise for that money, or whether we're talking to various external parties about a potential, like a MES type debt to equity type arrangement, which would reduce enormously the dilution requirement on the capital structure. So and also the people we're talking to are talking about alternatives of how that might work, and they're quite flexible in how it works. So that will be the first money in. If I look at that as a chunk, and some of it might be equity and some of it might be shorter term debt, or longer term debt, but debt to get us through the first 12 months, and then the banks would kick in after 12 or 13 months on their drawdown. So the bank funding's in place and under the contract, but it won't be drawn for 12 or 13 months.
Okay. And you've obviously talked about kind of refinancing this thing out as you will, because cost of capital can, it can, it can be tough, and you want to do that as soon as possible. You want to control the timing of that, and you want to be able to deliver up to a certain point before you even think about that. Will that be cash flowing, or will you allow yourself a little bit period of kind of ramp up? I mean, when do you expect to refinance?
Well, in terms of our finalisation to commence full production, we expect to do that in the next couple of months. So then the cash would start flowing. We've already started in anticipation of that to mobilise. We've signed contracts. We've got one LHD already doing prep work on the site. So we're advanced enough and confident enough that will be finalised pretty soon. In fact, I'm off on Sunday to Hong Kong to talk to a range of investors who've expressed interest as well. So we're sort of on that promotional trail at the moment, securing that sort of commitment.
Right, and how do you or the board feel about having debt on the balance sheet ongoing?
Well, it depends on your faith in the project. I mean, debt, it always has a risk, but then the major benefit is it's non-dilutive, and of such a small capital base. Assuming we could raise the full amount on an equity basis, it's going to be terribly dilutive to the long-term shareholders. So we think, the other thing that debt does, I think, is it validates to us and also to hopefully to external investors the fact that the company's been through a robust due diligence with bank standard diligence. I mean, we've been through that process with the bank's external advisors, 4 or 5 of them, on everything from environmental to legal to technical and so forth, and we've come through that process with affirmative reports. So I think that gives some people the comfort to know that we're not just telling you the project works, and our consultants aren't just telling you. So a whole range of external bank funded people are telling you it works. So
right, okay. So on the financing, but what about so technically with the build, for instance? Obviously, I want to understand the kind of risk there. So what are you building? And in terms of the complexity of it, and who's building it, and what have they done before?
Okay, so it's a standard build for the Wits. The Wits is, one of those ore bodies that has been mined for over 100 years, and its reefs run in concentric 45-degree declining, reefs, ore-bearing reefs, which are called pebbly conglomerates, I think is the term they use. These reefs, therefore, the style of mining in this particular project is going to be a decline accessing through a driving decline. Trackless vehicles will access then a spiral decline to go down to 850 metres over the next 16 years, and it's conventional stope handheld equipment. We're mining stopes that are going to be an average of about 1.4 metres width, so that's the best way to do it. As we get deeper into the mine, Rudy DeSalle, my MD, who's the mining engineer in charge of the project, who's built many projects in Africa, feels there's an opportunity to look at more mechanised methods, because of the reefs will steepen at that depth. But at the moment, it'll be a conventional South African, well understood mining method. So we don't see a lot of risk in that in terms of actually construction. We did a lot of work over the last few years to get the decline to a point where at level 2 now on ore. So it won't be, we'll be extracting ore within 8 weeks of recommissioning the mine. So it's not, that initial phase of breaking ground and getting established is done. So I think that part of it's de-risked. In terms of contractors, we'll have our own team, but most of the contract mining will be done by a group called Modi Mining, who we've worked with before when we did open cut stuff, and we did the original stuff with them in terms of establishing the decline. They've had a lot of experience in the platinum fields, in the Bushveld complex, and that style of mining there is very similar to what we're doing on the gold reefs around Johannesburg. Similar type reef vein type, narrow vein type mining. So yeah, there's always risks, but we're doing some innovation. Rudy's brought in, we're using hydropower in this mine rather than compressed air. He told me that he convinced the board this is a much better system to use, and most other mines aren't using it because they're set up for air compression, but the hydropower is a better way to go. So that we're also looking at establishing a solar renewable energy plant. So there's a range of things we're doing.
Okay, I mean, energy is a big concern in South Africa, obviously, because it's, I think, famously unreliable at the moment. So you're going to take control of that and build out your own energy source.
Longer term, but the power thing now, the power situation in South Africa has improved enormously. Up until this, and the old story, Matt. Good news doesn't travel. Bad news travels very fast. The power situation. I've been going there for 20 years to work, and obviously up until a few years ago, yes, it was pretty annoying because every time you were there, you had a power outage on the weekend, or you had I think Johannesburg was getting like 21.5 to 22 hours power a day, but with the load shedding happening, you could have a situation where you lost power for 4 or 5 hours on a weekend or something. But up until a number of things have happened, and it's worth just reflecting on them. First of all, about 3 or 4 years ago, the government moved to enable private companies to actually produce their own power to a much higher level than they were. So Eskom's sort of structural monopoly was dissolved. And that led to a lot more construction of these renewable type power projects around South Africa. So what that did, ultimately now we're seeing a lot of that coming on stream, and it's reduced by 10 or 15% the load on Eskom, because this other power is being generated to lighten the load. The other thing that happened was the government changed ministers, and they put a new team in. private industry, I know the Mineral Council were very active in this, which we're a member of. They seconded people into Eskom about 18 months ago, and they established a new maintenance program and a proper program to run it. So basically they said to the government, look, you guys are not handling this well, let us come in and help. That's been very successful. Up until February this year, in fact, where there were some minor outages because of an unplanned outage in a power plant, a coal power plant there, I think the statistics are up until February this year, they had 430 days without power load shedding in Johannesburg. So people are still talking about the unreliable power, but it ain't actually happening on the ground. On the ground, the power is actually quite good. And as I say to many people in Australia, here where I live, would you prefer to have even intermittent power on mains power at 1/3 the cost, or would you prefer to be in the middle of the Pilbara trying to truck your diesel in or build, it's manifestly better using grid power when you can. Our backup power will be done by solar eventually because it's cheaper for us to do it that way. So we will be looking at that. But in the short to medium term, we're relying on city power.
Okay, I'm sure you'll keep us up to date. Just in terms of the kind of the ramp up and getting to that kind of steady state, you're aiming for like 70,000 ounces a year. I'm interested in the setup, like your relatively small surface footprint. What are you doing in terms of handling logistics, ore haulage, and that kind of and during that whole kind of ramp up phase, and any other kind of the infrastructure stuff in terms of water controls or any kind of legacy issues?
It's really something that Rudy's best placed to answer, but I'll do my best as the chairman. They have a full ECPM contract team that are doing it. I've seen the charts and the step-by-step process they have in terms of how they're doing it. These guys know what they're doing. It's a phased, as you say, it's a phased process where at the moment our infrastructure on site, I think, supports about a 25,000 ounce a year production rate, and that'll be just continually built out until we get to the 70,000. One of the things we suffer from in terms of the market perception too, I think is worth just, again, putting in context, is that this project being an underground mine will have a life of mine of 17 years. This is the first stage of it. We'll have a life of mine 17 years. So we have to build the infrastructure to sustain that sort of production rate. And in underground mining, it takes time to do that. And whereas you suffer from comparison with some of the open cut mines, particularly in Australia here, which might take 12 or 18 months to establish, but run for 6 or 7 years. And that sort of return of payback period gets distorted but if you look at our mine, for the first 2.3 years, we're building the mine effectively before we can get to full state, and we're using the ore that we sort of develop, we extract while we're developing, to actually offset our costs. But because of the way the industry looks at it, they say, your payback period starts from when you start producing ore. What I say to people is, let's be a bit fairer and actually say that's really our development phase. Even if you allow us 18 months, which you'd allow any open cut 18 months to get to first ore, just defer your start period by 18 months, and then you can see we actually have quite a good payback period. From finishing of construction, I think the new DFS shows we pay back in 8 months. So it's very quick once we're up and going. But because it's an underground mine, we're building a bigger project that takes longer to build, but it will go for longer and it'll be more efficient.
Right, and let's remind people in terms of how you process. So, if you don't mind, tell us what agreement you come up with.
Yeah, we've struck an agreement. There's lots of available capacity in the area because of the history of this area in producing gold. I mean, most people know the Wits has produced 25 to 30% of the world's gold. So there's still a lot of gold plants in the area. We've spoken and entered an agreement with Sibanye-Stillwater. They have a plant, Ezawini plant, about 40 kilometres to the south of where we are. There's a main, multi-lane freeway to get there. There's no sort of travelling through towns or villages to get there, so our trucks can go strictly down the highway to the plant. We've actually used it before when we did some open cut mining a few years ago there, so we know the plant and we know the people. That's a 4-year deal. It's evergreen as far as Sibanye treat it, because it'll just be renewed, and they've got a best endeavours obligation to locate us into another plant if something happens at Ezawini. So we think we're pretty secure. The banks are certainly satisfied with the arrangement. But in terms of alternatives, there's also alternatives with Harmony Gold are operating the Doornkop plant next door to us, 8 kilometres away. Pan African Mining, which is an AIM-listed company, is doing great things. They've just built a great big plant at Randfontein, which is 25 kilometres away, and they're talking, I saw the other day, their CEO was talking in an interview about, they own all the dumps around us. They're doing these reclamation of dump material, and they're talking even now about potentially building a plant right near us, on our footprint basically. So if they did that, I'm sure there'd be an opportunity to sort of attach a hard rock circuit there and take our material as well. In fact, they've already approached us about taking our material to Ramfontein. The only reason we went with Sibanye, Pan African have a brand new plant, was that their plant hard rock capacity is about 30,000 tonnes a month, and our peak production we get to 70,000 tonnes a month, so it's a bit small for what we wanted.
Right, okay, and talk to me about this. I should have asked some before, which is around employee safety. Right, South Africa, has got a long history, say like over 100 years worth, in where you are. Some of these old mines have proved to be dangerous. What steps, what processes have you put in place, and who's managing that?
Well, first of all, just at the high level, I suppose I'd say at the macro level, I sometimes describe South Africa as a first world country with third world costumes. It actually does have a lot of first world standards. Sometimes they're not necessarily enforced as well as they should be, but in mining that's becoming less and less. I mean, they're far more compliant now and aligned with what the normal Western type operation would be. The other thing that I think that distinguishes this project is most of the projects in South Africa, and they're probably one of the, I suppose, structural reasons why they've suffered from a safety issue. A lot of manual mining, with as we said, which we will be doing, but also a lot of their mining at depth, because these reefs have been mined for so long. Doornkop, the Harmony Gold next door, are down at 2,200 metres now on the same structures we're about to start mining at surface. So at least for the first 10 or 15 years of this project, in 17 years we only get to 850 metres. So, we're a shallow mine, whereas a lot of these accidents and issues happen with deep mines, heat, all those sort of things, rock shear, rock explosions, whatever they call them. That sort of stuff is not happening at this level.
Okay, good to hear. With regards to the long-term growth strategy here beyond Qala Shallows, it's a big, prolific district, the Witwatersrand. Where do you go from here?
Well, we have a few plans there. We have a massive resource. We've got over a 5 million ounce resource at 4.66 grams. So imagine if we had that in West Australia or somewhere. So it's a very big, well understood resource. It's in a very small area that's all contained within about a 4,000 hectare footprint. So it's quite a small area. So there's plenty of opportunity to expand. This project itself uses under 1 million ounces. So this stage one that's in the DFS only. We've done scoping studies though that show us utilising other areas. The scoping studies were really closer to a PFS, but what we've identified is there's an opportunity, we believe, with the ore bodies that we have, to take this to 200,000 ounces a year for about a 25-year life of mine. Now, to do that, we need to do more work, which we've been holding back doing while we're a small miner with no money, but we will do that work. Part of the issue, a couple of the key issues will be, you need to have a plant, dedicated plant, because you're not going to be able to truck that much ore around the veldt. So that's an issue that we're looking at, and there's various options we're looking at there. They range from construction of our own plant, doing something with someone like Pan African if they move into the area, or we could even look at taking part of the Doornkop plant, which is next door, and conveying, having an ore road or conveying it over there, so by a conveyor belt. So the other issue that we need to deal with is deposition, because they're not going to let us start building those mountainous dumps anymore in that area. They've had enough of that. We had preliminary chats with the regulatory authorities on that, and they're all aligned with us that a good idea, subject to solving some of the technical issues, which we think are very manageable, is we would put it back down to the old voids. And what we'll do is effectively displace the acid mine drainage water that's there with old material that we're mining, and therefore effectively fill up some of those voids. And that's something that they think they're very favourably disposed to that, and that would be a long-term solution. But it'll have to go through an environmental process and so forth.
Right. And obviously, we're talking about Project 200. I think you've named
it.
Yeah.
So we call it because we say we can get to 200,000 ounces. That's the aspiration.
Right. Okay.
Aspirational target. Yeah.
Right. Okay. And obviously, look, it's early days and it's aspirational at this moment. But just in terms of understanding the kind of how you treat capital, are you happy to go on a high leverage route, or do you finance this out of what you're making at Qala Shallows. I mean, how are you picturing this project 200 being built, 200,000 being built out?
I think we could be self-funded because this project, once we're up and running, it generates a lot of cash. And we can pay that out, or we can redeploy it into creating. If we're saying we're going to use people's money to go off and look at exploration and stuff of unknown quantities, then that's probably a risk strategy that some of the shareholders would understandably have an issue with. But when you're sitting on a 5 million ounce resource, and remember the historic resource here in 2000 was reported at JORC at 12.8 million ounces. So we haven't brought a lot of it back onto the books yet because some of it's underwater. We'd have to plug and pump and do things, so we're sort of, those studies can all be done. But what I can say is if we are taking the money we're making from this and redeploying it into expanding the project, we're not doing it on a whim. We've got some really solid evidence of the resource there. We've got the capacity. We've got a great history of mining in the area, great expertise. And it's not like we're operating in a remote site. We're in the middle. We're sitting between between Soweto and Rudaport. So it's a very doable thing. So we'll do it in a measured and prudent way. But I think generally that would be our preference to do it that way.
Right. Okay, so first things first, let's get phase one built out, get some money flowing, obviously. Right, obviously, I think we've mentioned a couple of times here, let's say, and I'd be disappointed if you didn't tell me you're undervalued. How do you kind of close that valuation gap?
Yeah, it's a perennial issue for us to understand valuations and how that translates. I mean, there's always going to be discounts for companies. We know that I think was it Pierre Lazonde that came up with the famous curve that always reflects the way markets work, and to a certain degree, and also the delays that inevitably happen with these sort of projects. What I can say is we are project ready. We have all the turnkey approvals in place. So I think the only way to break that sort of cycle of trading, if you like, the churning and the trading that happens, it's good for liquidity, it's good for small stocks, but at a point you have to grow up and say, now we're now producing, look at us as a producer and measure us by whether we produce against our milestones we set and so forth. And I think we're close to doing that if we close this funding. And I think that will naturally then reflect in the stock as we attract more long-term value-orientated investors and funds than people that are just playing the market. I mean, the Australian market's a great market for sponsoring. Traditionally, we grew up down here on sponsoring exploration companies, so people became speculators. That's the way it works at that level. You've got to get through that level and to become a producer before the big boys will come and sit on your register. And I think that's the transition we're in. So there's an opportunity now for people to see, have a look. Yes, the question for them to ask, I suspect, is can we get this funded and get going? And that's the judgment to make. Because if we do, there's no doubt we will re-rate.
Okay, so when I do a tick box exercise here, which is okay, if you can get that funding stack lined up, sounds like you're pretty much there. You've got the licenses, permits, you've got the people.
Yep.
You've got the DFS suggests that it should be, very decent margins indeed. What are the other things that you're sort of saying to you, seem like we need to get this stuff lined up and we need to get it lined up now?
Well, we've had a lot of time preparing, so there's nothing that's obvious there or material. I mean, the one thing we do continue to do, because it's an important issue, I think, operating in Africa generally, but particularly in this area because we've got a high population, our community relations and what we do with them, the economic sort of programs we have with them, the educational programs, that's something we're very hard, strong on, not because of just the altruistic need to do it and the statutory and regulatory need to do it, but because it's good business to align yourself with the community, and that because it comes with a workforce that can walk to work. It's a great opportunity you don't have to fly in, fly out, all that stuff. People go home in the afternoon, they come back in the morning. So we have to also, we get the benefit of it. We need to also make sure we look after our obligations. And so that's one thing that I think is probably, the factor that it's harder to sort of exactly pin down what you need to do, but I think we're doing a good job of what we can do on that. And that's something you can't ignore. Don't take it for granted, I suppose, is what I'm saying.
Right, okay. And just, I guess one final thing is in terms of looking the share register and, how that's constructed at the moment. Obviously, a company of your size currently will have a certain profile. What do you feel that you need to do any work on that in terms of dual listing on the Johannesburg Exchange or TSXV or wherever you're thinking?
We're looking at it. I mean, you're right. Our register at the moment, we've got a few institutions came on in the last round, particularly out of Asia. So that's a good start. But traditionally, we have a few big family high net worths and that on it. And the good thing about those guys is they're there for the long haul. They haven't gone anywhere. They haven't sold a share. It's all the trading happens down in the lower echelons, I suppose, of the company. But I think we will push ahead with that sort of institutional sort of profile we're trying to build and show our case. And in some areas there's some resistance to the jurisdiction because of the history. But I think basically it's not drying up. It's just making there's less people to talk to. There's some people who don't want to talk about South Africa. Some people do. I think that's a long-term fix. I can't do much about that, but long-term I think that will come around as well as the country develops and improves. But so that's what we're definitely trying to improve, if you like, the profile of our investor register.
Michael, appreciate your time today. Really nice update, and good luck with this move forward that you've made with the PFS. Thank you very much.
Thanks,
See
Matt.
you soon.
Thanks very much for your time.